Hello, everyone. For today, we have a very special video because we have a very special guest, which is Matt Warder, one of, or if not the most knowledgeable coal analyst that I know of at least. So it's a pleasure that you were able to find the time to meet with us and discuss all things coal. Hello, Matt.
Hello, Albert. Thanks for having me on. I love talking about coal all the time, anytime, whether markets are good or bad or indifferent. It's just, for me, it's spent a good portion of my career in the sector, and it's one that gets absolutely no love from,
Yeah,
from traditional funds or finance now. And so really, the audience has shifted over to generalists, retail value investors, that kind of crowd. And it takes a while to kind of get used to everything. So I'm here to be an ambassador for the industry and to talk about how that the outlook for the commodities is okay here over the next decade or so. So there's a lot of interesting things going on within the sector that I think you're probably going to touch on here at various points of
yeah.
view.
Yeah, for sure. We have a list of topics that we have agreed on to talk today, but of course, feel free to add on anyone that you feel like that is missing or wonder on the road of call, because anything that you find valuable or that you find that's interesting to share will be of great interest for our subscribers. So thank you. Before starting, I would like I would like you to introduce yourself, because maybe someone in our crowd doesn't know you or wants to know where to find you afterwards, etc. So if you could
Sure.
please share a little bit about yourself and your
Mhm.
background, that would be great.
Sure. Well, yeah, my name's Matt Warder. I'm the publisher of thecoaltrader.com, where it's pretty much the only independent, research website uh, that is, that's out there on the web at the moment. Pretty much all the rest of the research is either institutional in origin, which means, there are sort of central tenets that, will get dictated down to analysts in certain sectors from a top down perspective. We don't do anything like that. We just kind of look at the landscape the next 3 to 5 years, which is the immediate investable future, and try to determine risks versus reward for all the different types of coal. I got into this business actually from the music industry. I was in a band for about 10 years. We did pretty well, but we were all teachers as well. I taught in the school system, and I taught
Okay.
privately. And then when music career sort of came to an end, I actually had a guitar student step up and say, "Well, I could use some help doing what I'm doing." And I never quite sort of understood why I said yes, other than, we got along real well. But as it turned out, when I came into the industry, there were a lot of similarities and overlaps between, even music and equity analysis. I mean, at the end of the day, if you're writing a song, you're solving a problem. And, in equity analysis, it's not necessarily creative. It's just, it's math and trying to find, the path to the correct narrative to communicate to people what an investment opportunity is. So that there are more similarities than you think to the workflow, and it's helped me sort of balance the quantitative with the creative side, as well as I stopped writing for institutions and started writing for retail and generalists and non-experts. So it's sort of weird. I've kind of come full circle in that I'm kind of a teacher again, for lack
Yeah,
of a better sort of
yeah, for
phrase.
sure. That's
But
something I didn't know about you, the music thing. So quite an interesting background, and they're like, I think it's very unique, right? I don't know anyone who has made that kind of career switch. So it's great having another perspective there.
that's right. I wouldn't advise it either. Like, it's better to get this speed on.
Yeah, you
Into
have double the work. First of all, learn to play an instrument or learn to sing, etc., and then learn the code. It's double the work, and
Oh yeah,
and
yeah,
not
yeah,
as yeah.
for sure. But yeah, there are things that we brought over from the one skill set that turned out to be applicable here, which are great. So I mean, you're telling a story in music in the same way that you're telling a story with data and math and management and the history of the company and the history of deposit and all those sorts of things. So there are enough similarities that it's allowed me to take a fresh perspective to it, I think.
Okay, that's great then. If you could transfer some skills, that's great. Later on, I will come back to this, because we have some questions also, that those I didn't share with you, but some of our members in the Discord shared some questions, and one of them might be related to what you shared about your background and how to learn the ropes. Let's say so. We will get back to that.
Good.
If anyone also, apart from the Cold Trader, wants to find you, also are active on Twitter, I will leave the handle below so that they can contact you there or read you there. Matt has always been very friendly and open and generous to share things there, so you will find great value. Okay, so
let's
get into the topics. And the first question is not really a question; it's a broad point. It's a little bit abstract because not very concrete, but we will be focusing a lot more down the interview. But first of all, how do you assess the current market conditions? Like, where are we now? If someone just got into coal or this year he hasn't looked at the market, the portfolio, etc. Where are we now? How are the prices, etc. Like a current analysis of the current situation, let's say.
Okay, well, I mean, it's important to sort of preface that with saying that, coal isn't one thing or one market, it's several different things. Primarily, we divide it into two primary subcategories. The first being thermal coal, which is used in power generation. The second being metallurgical coal, which is used in steel making. In the first one, it's just, you're burning coal for heat, boiling water, turning turbines, etc. You need to have a blend of coals that don't mix together in a way to form, a clinker that would foul up the boiler. So there's a little bit of technicality that goes into it, but most boilers can take a range of coals that they know are available in the market, and they kind of stick to that. Metallurgical coal is a little bit different. Metallurgical coals, when you heat them up in the absence of oxygen, they don't turn into dust, like a lot of thermal coal would do. They'll start to melt, sort of, and they have this like fluid property. And if you have a number of different coals, in a targeted blend, and they all kind of get liquidy or less viscous at the same time, then they'll blend together to and then when you cool them down, they'll form these baseball-sized chunks of charcoal, essentially. And that's metallurgical coke. Metallurgical coke has two purposes. One is that physically it holds up the layers of coke and then iron ore and coke and iron ore in a blast furnace. And if it's strong enough, then it's also the fuel. So it heats up. You fire natural gas under it. The charcoal heats up, and converts the FeO2 in iron ore. The carbon picks off one oxygen atom to become molten FeO, which is iron, the first stage of steel. And then the gaps between the coal, the liquid metal will trickle down to the bottom of the furnace. You tap it off. You eliminate any kind of limestone slag that's on the top of it, and then you cart it over to the basic oxygen furnace to do the last round of reduction and turn it into molten steel. Not all coals can have those properties. So metallurgical coal is kind of a specialized industrial coal. It gets usually, although there was a period in 22 where it didn't, but it almost always gets a premium over thermal coal, a pretty significant one too. So if we're going to assess the market, we kind of have to do two assessments. So I'll let you choose where you want to start off, and then we'll go from there.
Okay, yeah. Our main interest is in metallurgical coal, but also let's delve first into that one. But of course, if we can touch a little bit onto thermal afterwards, that would be great too.
Okay. Let me see if I can present here. Because I can show you.
I don't know if it will let you. Let me see. It should, but if it doesn't, you can share with me via Twitter whatever you want, and I can share it. But let's see if you
try. Let's see there. Does that work?
Oh yeah. Yes. Okay. Now.
Okay. Okay. So up on top here, and let me take off the numbers in here. This is the blue line here is the price for premium low volatile metallurgical coal. These are the futures that are traded on the Singapore exchange. Right now, they're around $252 per ton. And as you can see, just a year ago, not quite a year ago, back in October, we were up in the 360 range. If I pulled out to 5 years, you can see during the start of the Russia-Ukraine war, we got all the way up to 620. So it's come down by, 2/3 since then. But if we go to all history, you can see where prices were, when times weren't so great in 2016.
Yeah, exactly.
Yeah, so
There seems to
most
be
of,
like a new base level.
yeah, exactly. So most of the time they've hung out in this range, which is call it, 150 to 200 in years past. Obviously during COVID, the market got incredibly cheap again, but that's what made a fair portion of supply go away. And of course, when the supply goes away, it's not elastic enough to come back when it's needed. That's why the price skyrocketed as much as it did. But we've kind of settled down into a range here that is supported on the floor by right around $225. And what I suspect that is, if you take the average global cost at the port, 90th percentile of the entirety of the cost curve, you're talking about probably $190 per ton, per metric ton overall. If you add in sustaining capex, SG&A, and taxes, which are all about $5 per ton a piece, you get up into the 205 range. And then if you add in a 10% profit, because keep in mind that these operations don't really have ready access to finance, you kind of get to that 225 level as a base load below which operators are going to have difficulty making profit and make shut-in operations, which then tighten the market and make the price go up. So this 225 level has been kind of the floor. In the fall, both India and China were in the market buying restocking tons for their steel plants. And because they were both in the market at the same time and macroeconomic conditions were pretty good, the price got all the way up here to about 360. I think this is probably where the functional top is in a normal year. Yeah. So we're sort of looking, I think, in most years between $225 and $300 to $325 with upside to $4, during periods that are really, really active. So from a pricing perspective, we're at 250. In general, the market will kind of bounce along these lower levels in summer. And then right at the end of the summer, when restocking picks up, will tend to go up. And equities usually go along with it. Obviously,
last year there was a pretty spectacular rally starting in August. So that matches perfectly with what you're saying and the seasonality of coal, which we will touch on later on. So great. And not only that, but referring to prices, I want to ask you because right now we could say that the market is fairly tight or at least evenly matched. But if like the World Steel Association and other organizations predict the steel market keeps growing, barring any macroeconomic downturns or temporal macroeconomic downturns. In order to bring new supply to the market, there would be need for a higher price to incentivize that new supply. Is there readily available supply ready to come to market if prices stay at this range or?
There are a number of projects that are already in some semblance of completion that are going to come on. There is Peabody's Centurion mine in Australia, which will be about 3 million tons a year of low volatile metallurgical coal. There's Warrior Met Coal's Blue Creek mine, which is about 4 to 5 million tons of high vol A metallurgical coal. The different types of volatile content are how we divide up the market. Low volatile is about 20% matter that gets driven off of the coke oven. Mid volatile is between, call it 22 and 28, and then high volatile content would be above that level. It's basically a proxy for how much carbon is contained within. The lower the volatile content, the more carbon you have. See, the bigger the price. But there aren't a whole lot of low vol and mid volatile coals that are coming to market here over the next few years. And those are the coals that contribute strength to the coke, so it's able to hold up the burden. And so, we kind of suspect that prices are going to hang around here for a good long while. They're buoyed by cost inflation for one, but also just the fact that there's very little new supply coming to market. On the high vol side, and there's another type of coal called semi-soft, which is sort of more of a filler. It's not a super strong coal, but you can put it in the mix without damaging your your coke strength. Those fetch lower prices. They're kind of closer to thermal coal, but there's a lot of those mines that are coming on. There's a lot of kind of lower grade, high volatile coal mines that are coming on. Just not much premium
High
stuff.
quality, yeah. Okay.
Yeah.
And that's especially interesting in an extractive industry because that's one side of the equation. Of course, new supply can come in, but there are also some mines that are going to be depleting themselves. And you were talking about Warrior Met Coal. One of their mines is not that long life of mine remaining, right? So that will be an interesting dynamic for sure.
Yeah,
And
now they have other reserves that they could lease, which I suspect they will, but
yeah,
they'll cross that bridge, I think, when they come to it, because it's pretty well known who owns them and that they're available if needed. It's just a question of whether it makes sense to go get them. The one thing I'd point out before we move on from this chart is that this is TradingView's Bollinger Band trend, which has been a pretty good indicator. It's kind of the difference between the 20-day and the 50-day Bollinger Bands, and usually when that expands, it's confirming that a trend is beginning, and likewise when it begins to slope down, that's usually a signal to move. Well, we've moved from this pretty big downtrend here in March and April, and finally the trend has sort of turned positive. So, this is a good time to start to look at the sector, the met coal sector in particular, just because we do have a little bit of seasonality in our backs, macroeconomic conditions aside.
Yeah, that's very interesting. Yeah, to look at this kind of indicators. So thank you for sharing that.
Sure.
And now I suspect you want to move on to thermal.
Yeah, I'll pull up the Rotterdam chart because
you actually covered a little bit of our next topic because it was about seasonality and what to further expect in 2024. So you already covered that a little bit with Met. Of course, we can discuss it a little bit more, but you already delved into that topic.
Yeah, so let me pull up a window. Here it is. So this is coal delivered into Europe, which is sort of the basis for seaborne coals for this side of the world, for the U.S. In particular. So the market topped out in the wintertime at around $140 and has gotten as low as about, let's call it 95. So at $95, you're butting up against the break-even cost of the largest supplier from the United States, which is CONSOL. CONSOL mines its coal for about $35 a short ton at the mine. It rails it to the port for about, call it $20 to $25. So that gets them to 60. If you adjust for metric tons, takes you up 10% to 66. And it's about a $15, $20 boat ride over to Europe. So it's delivered for 86. And then if you add in 10% profit again, you're talking about $94, $95. This is held up twice through the cycle now, and looks to be kind of where you should think about the marginal ton hitting. Seasonally, during April we had a little bit of run back up due to weather and some other tightness on the gas side. We got up to about 122. I think that's kind of a pretty good midpoint for what to expect. And then, top wise, 140 to 150 for European coal. And again, we're not in the best season to begin to buy it. That's more August, September, after summer has summer burn season has passed and utilities come into the market to restock. That's usually when prices tend to get better. September, October, November. So still a good spot, even though, we've kind of moved off the bottom and are moving back upward. It is still a really good spot to look at. So let's also look at Newcastle.
Yeah, that's the one that we tend to follow more closely week after week.
Yeah, so Newcastle is going to be the same sort of pattern.
Behavior,
yeah. The top is going to be a little bit different. It's going to be a little bit more favorable, up to around close to 170 here this past off season, and its floor is closer to 115. That's butting up against cost for some of the higher quality thermal coal producers. That's kind of the around where the cost for like PCI and some crossover type coals that could go into either market, either semi-soft met or PCI met, or thermal coal. And I think that's a pretty reasonable assumption. We might be able to get down to 110, 105 in a really kind of nasty market where gas is super cheap. But in general, I think call it 115 to 170 is a pretty reasonable range. And we're in this period, I think where we're kind of going to move along in this range for the next 2 or 3 months, and then we should get its seasonal run up as well. So again, pretty good position from a seasonality perspective. Most restocking tends to happen after summer's over, whether it's India buying cargoes for after the monsoon season passes, or whether it's China just seasonally coming in after after they have a summer burn season. So thermal coal and met coal, for better or for worse, have kind of their seasonality has kind of converged over the past years. It didn't used to be like that. Met coal used to have 2 distinct restocking seasons, and thermal coal was strictly by the weather
related.
Yeah, and that's since India has become a more prominent player on the met side. That restocking has shifted more toward September to January, February, and then kind of a 3 to 6 month off season, so to speak. So a little bit of a change there.
Yeah, great overview. And just like focusing on the met coal, our next topic is there's a lot of chatter going on or some worries that the macroeconomic side of things isn't that good, and there are some countries which have been historically, or at least for the past 20 years, a great point of demand, a great like China, for instance, with all their demand, and that now are starting to show some weakness, especially their construction sector, etc. It is true that there are other countries that are picking up a little bit on the demand side, and you mentioned India, which has a lot to build if they want to scale up on the income scale, let's say, with infrastructure, etc. But how do you balance, or what would you say to address those who's right? Is there a new paradigm with supply constraints and cost inflation, or are the macro woes and especially the changing paradigm in China going to mean that going forward we're going to see weakness on the met side?
So my suspicion is that the green transition, or the transition to in China's case to electric arc furnaces, is probably going to be a lot slower and have a much lower ceiling than people think. That's more of a 2040, 2050 story, and I do think it moves up gradually over time. The bigger question is is their economy going to? I mean, if China's economy goes in the absolute doghouse, that's bad for everything. It's not just met coal. It's bad for retail. It's bad for technology. It's bad for, literally every sector. So, I don't necessarily view China as an existential risk to met coal specifically. They're not even really a big participant in the seaborne market anymore on the met side. They Mongolia ramped up production. They built this big rail corridor that finally got going like gangbusters in 2023 after being frozen out either due to COVID or just delays in construction in general. And that actually balanced the market. That's part of the reason why prices came down from 600, to 225, 250, is that China's getting most of the material that they need from Mongolia. And then the other piece of the puzzle has been Russia. So with Russian sanctions basically rendering production from the country persona non grata in most G7 nations, Europe, Japan, Korea, Taiwan, etc. There's really only a couple of places for Russia to go, and that's India and China. China, of course, doesn't care about sanctions. They'll trade in yuan and barter. India does. I mean, I don't think they're going to do business with directly sanctioned operations. But I know they're clearing crude oil in Kazakhstan, for instance. So there's probably some other ways around that. Russia did announce that they're going to, move a rail corridor down through Iran to export and then go to the western coast of India. Again, if sanctions are affecting individual operations, I don't know how much that's going to matter. But if there's another clearinghouse in the middle, we'll see how that goes. But there's not a whole lot of difference that China can really make to the seaborne market, unless they either export a lot of coke. They're already offshoring some of their coke operations to Indonesia, so that's a 1-for-1 swap, right? Or they could export a lot of steel to the rest of the world, which other countries can import and lower their steel demand. I do think they'll do that for the next year or so. There's a really similar period back in 2014 to 2016 where China was dumping a lot of steel on the global market. I think we may see some situations like that over the next year and a half. But from a real estate perspective, I don't expect things to get that materially better going forward. But that said, there are a whole lot of completions that haven't even been started that have already been paid for and invested in.
Yeah.
So I think there's enough downstream demand to kind of keep China flat for the near term. And that means they'll still need to come into the market for a few tons to contribute strength from some combination of Australia, Canada, and the United States. Not in a big number, but in enough to keep things moving.
Okay. Yeah, it's very interesting. And I read an article from Gehring and Rosenwag that they said that if you want to keep your middle class growing, etc., you need a certain amount of steel per capita installed, right? So even though real estate might be now down the toilet or in a very bad place, all these countries where the economies are starting to take off, especially like you said, India, Indonesia, where demographics are also supportive of this trend, will need to. I mean, we cannot comprehend the amount of demand that may come from them if they really start ramping up their economy. So I also tend to think that we're not in that much of a bad place. And especially with cost inflation, like you said, how many projects are going to be producing at a loss if the marginal producer, like you said, is at 220, right?
Yeah, and that cost inflation isn't going away. As long as commodity inflation and cost inflation are going to affect consumers, it's going to be reflected in pay because people need to keep up, with inflation at the very least, which and companies are obliged to do that or risk losing their labor force, which is already incredibly tight, especially for mining.
So for coal mining, especially, it's very difficult.
Yeah, I mean, there's such a shortage of mining engineers worldwide. It's really difficult to find any kind of labor here in the U.S. You have to train them from scratch pretty much at this point.
We saw it now with Warrior Met Coal, like you said, with Blue Creek. They had to hire the people in advance of the construction and pay whatever was necessary to make sure that they had the right people for the operation. So it's going to be a trend, and also machinery, etc. So
exactly. So I think that cost floor is in there pretty solidly, and it makes me optimistic on price. Maybe we don't get $600 again anytime for the remainder of this cycle, but I feel pretty good about 200 to 225 as the floor. Can we go down below that temporarily? Yeah, I think so, but I don't think you can stay down there for like 2 quarters and expect supply to be robust. And if can the players in the industry survive 6 months at 190 or 180? Yeah, they can.
With the balance sheets they have now, yes, but
and they're not, because they don't have as much debt, they're not obligated to produce in order to make interest payments or do anything like that. They're a lot freer to labor force. Just like we're saying, is the more important aspect. They need to make sure that everybody's working, so they have enough people that when the boom times do come, that they can make hay.
Okay, yeah, great. And just touching on another subject that's directly related to this, how do you see the terminal value for these companies? Because there are some ESG pressure for sure to phase out coal. Maybe not everywhere in the world. We're seeing that peak coal has already been reached in Europe and the United States, or maybe not peak, but let's say that might be true, but not in other parts of the world like India and China, where consumption is still growing. And also for met coal, the technological possibility of a disruption, like could still be made economically and at scale without coke.
Both really good questions. Let's address the thermal coal side first, power generation side. It's largely the energy transition is largely a developed market phenomenon, right? The assumption is that developed markets in Europe and the United States will be able to move beyond coal because we have other avenues. We can build natural gas plants, or we can build nuclear. We can bring on solar and wind. At least co-locate solar and wind with industrial facilities. Instead of having to rely on them on the grid. Like, we have solutions to not necessarily have to rely on coal. And to be fair, it's more expensive to build a coal plant than a gas plant in the U.S. and Europe anyway. So why would you do it? It doesn't make any sense. But that said, India is going to burn a lot of coal between now and the next 30 years. So, like, I kind of view most of it as offset to some degree. Similarly, China, which is the largest producer of thermal coal on the planet, consumes a whole lot, and they import a pretty fair amount to make sure that they can, the power is always on. And you have to keep in mind, like, they're in the process of transitioning their vehicle fleet, right? So they've really pushed electric vehicles out to municipalities, trying to right size and future-proof charging infrastructure. But the reason they can do that is because they have a lot of coal-fired generation. They have a whole lot of baseload coal generation. So for them, it makes sense. They already have the power infrastructure in place. So they're going to attack the vehicle side of emissions first. And that makes sense. That makes absolute sense for how they need to go forward. But it doesn't mean that coal is going away. It just means that coal consumption, although it may peak and begin to, roll over, is just basically being transferred from developed markets to developing markets. And, the sooner we sort of kind of get on board with that idea, the easier it is to figure out how best to fit in the rest of the puzzle in developed markets as well. Like, you can't prevent countries from trying to get access to energy and those sorts of things. And we don't want to prevent that as a country or as a region.
Especially with the new kind of generators, the Healy, etc., that aren't as bad as that. And just before we move to Matt, also I want to ask you, Matt. I didn't forward this question in advance, but it's something that I have been thinking for a while, and is we always talk about Asia like a new pole of demand, which is growing a lot, especially like you said, Indonesia, India, etc. But the demographics are also very supportive in Africa, and the demographics are going to. I mean, these people are still burning biomass in a lot of places to power themselves. So, do you also see like a surge of demand coming from Africa in the coming years, or is that something that you're not thinking about?
I mean, no. We've been talking about it in the industry for decades now. It just hasn't materialized yet. At some point in time, it will materialize. It's just a question of when. So, my suspicion would be that, Africa should use the fuels that are best available to Africa, try to keep it, keep economies sort of close, and, the one thing they just need freedom to do is to develop how each country sort of sees best for its own path. I was in Namibia a few years ago and had a meeting with the Minister of Mines and Energy, which was pretty fascinating. And, the question was asked, well, these Western companies that are coming in to, help explore for natural resources, what do you want to get out of those relationships? Before the person could get the question out, the minister pounds the table and says improved individual outcomes. And so that stuck with me, loving people as much as I do from all over the world, having so many friends, in various countries. Like, that's what we want to see sort of as a society. And if that means, they need to tap oil and gas reserves in order to build, even simple spilling engines to provide power for the first time to what are, sometimes, 90% undomiciled residents. Like, have at it. Like, go at it. That's amazing. That's exactly what, is going to help. And then, obviously natural gas from a fertilizer perspective can help with, food poverty. And access to infrastructure. So, in my view, that demand is probably going to happen, but I think it's going to be like pockets of progress that happen locally. Namibia is this great
Not
offshore.
like a big wave, but it's indeed like, okay, thank you.
But like specifically like projecting increased coal consumption, I don't know. That's getting speculative and ambitious.
Okay,
I expect you're probably right. But I mean, for our investment horizon, the next 3 to 5 years, the story's all Asia. Vietnam, Malaysia, China. How did Japan, Korea, and Taiwan go? How does India develop? I mean, that's really what's driving the bus here in the near term, and we can hope for positive developments for
let's leave that for the next cycle, right?
For our brothers and sisters in sub-Saharan Africa.
Yeah. And just to recap, we were also on the Met side. How do you see technological disruption? Can that be a problem for Met in the short term, medium, or long term?
Sure. Well, there are two, 3 different types of technology that are trying to be introduced to green up steel, the steel industry globally. My first thought on it is that I think steel in total composes about 8% of global emissions. So it's not a very big contributor one way or the other. And a lot of that in developed markets comes from reliance on the power grid too. So, it's even the transition from blast furnace to electric arc furnace to move from making virgin steel to recycling existing steel is a difficult transition to make if your region doesn't already have a developed scrap market. We have that in the United States, and even it gets tight from time to time because the barrier to entry there is just labor, right? You have to be able to go get the scrap and then package it and transform it and then market it. Europe, which is trying to push toward this, a quick transition from blast furnace to EAFs. Europe does not have a developed scrap market in particular, and so these furnaces in Germany, the ThyssenKrupp's going to build the plants that are going to replace Dunkirk and Fos-sur-Mer for Arcelor in France, for instance. The government's footing between 50 and 100% of those bills. In Germany's case, provided it'll pass a balanced budget amendment, so they're going to get built. The question is, how are the companies themselves going to use them going forward? What's going to be their availability? In the United States, the nice thing about EAFs is you can just turn them on and turn them off when the macroeconomics are right or when they're not so good. So you can literally flip a switch and slow down production. You can't do that with a blast furnace. So what I expect is going to happen is that these companies will use these new facilities to optimize downstream deliveries, but they're not going to take, the blast furnaces themselves offline. They're going to produce it all together and use the resources that are best available in as cost effective as possible. So, in short, I think that means we have a slower decline in blast furnace production in Europe than I think a lot of people project. And that said, the macro picture is way more important for Europe here at the moment anyway, right? So we've troughed, and I think we're probably on our way up. So I'd expect to see some recovery in steel demand just in general. In fact, U.S. Steel just restarted its Košice plant today. It came out in the news. So to me, that's a really good sign that I think things are probably looking up.
Improving, yeah.
Yeah, on the continent. And then the other thing I think we have to sort of talk about over the longer term is eventually the Russia-Ukraine war will end. And I don't anticipate that they won't rebuild the steel sector, whether it's Russia, if they wind up with Zaporizhzhia and, Donetsk and Luhansk and those regions, they're going to rebuild that steel plant. Similarly, the damage that's been done in Ukraine, either to Kryvyi Rih or some of the other plants, there's going to be Western money to funnel in to rebuild that. And, that's going to be an increase in low volatile and mid volatile coking coal imports. not huge, but a few million tons, and a
Yeah,
few
but
million
when
tons.
everything's so tight, it can really move the yeah.
Exactly. When supply is tight and you get
Yeah.
like an uptick of like 3 to 5 million tons, it happens like that. You have another potential for kind of these big moves to the top. So you've hit on the crux, which is like, how does technology sort of balance the way down? We're going to build more EAFs in the United States for sure, and take down coke plants. If Nippon owns U.S. Steel, at the end of this year, they might do the opposite. They might turn some back on so that they can export to countries that don't have tariffs with the U.S. So they can right size their global production, which would be great for American jobs, by the way. Attention, Steelworkers Union, which would be great for coking coal consumption domestically, which isn't so great from an emission standpoint, from the government's perspective, but for jobs, which in a period of pretty high inflation, I like ideas that kind of ensure that we have work for working class folks, and those people are contributing taxes and buying stuff at the store. Like, that's all, to me, that's all velocity of money, econ 101, good outcome, sort of thing. So anyway, that's sort of where I'm thinking here right now.
For sure. Yeah. Thank you very much for that. And if someone is listening to this interview, he or she will be thinking, okay, it seems like we're in a relatively good spot right now, and things are looking good in the future, or at least not as dire as the industry and analysts paint them to be. So this seems like a good industry. But when he or she looks also at the price charts of some of these equities, and the first thing that comes to mind is, okay, I've already missed this train, right? This this has gone massively, a
Uh-huh.
massive appreciation in the last year, so maybe it's too late for that. What would you say to those people, Matt? Is there still value to be found in this sector and this industry?
Yeah, I mean, the short answer is yes, but the trade has absolutely evolved, right? So we've already captured the beta of the coal price move from historical lows to historical highs, and the buyback programs, and the buying back of debt, getting into a more improved financial position for all these companies has caused them to re-rate off the bottom. And in addition, we have better pricing going forward, so that re-rate has had extra positive impacts going forward. So now I think of it more as an asymmetric trade based off of a commodity price, and more like sort of like tobacco stocks, or master limited partnerships, where you have a company that produces a commodity at a really good margin, and there's not really that much else to do with the money. There's very little M&A to happen. There's not really any appetite for additional projects, and if there were, I'm not sure the market would necessarily support it. So you're left with, okay, I guess I'll give this back to shareholders.
Yeah.
And like, if you think about it from a so they're kind of grandpa stocks, I guess is probably the best way to put it, with the exception of a few.
I think you're the first person to say that about a coal company ever.
Yeah, well, it's like, these guys are going to produce between, in a bad year, like 5% free cash flow, and in a good year, like 25 or 30% free cash flow. So, if you're getting that money back, of course, there are years where it's going to underperform the market, but, it compounds over time. And, in addition, when you have those years that do outperform the market, you're going to outperform it by a wide margin.
Yeah.
So I don't think, it's not done. You asked about terminal value. Like, most of these companies have 10 to 15 years of mine life left, and they're only being given credit for still 2 to 5. So so if that's the case going forward, then there's more money to be made there than I think people sort of give it credit for. And then there are also still companies that are growing, and those are probably important to highlight. I would assume in the follow-up question, right?
Yeah, we will talk about it right now. I just wanted to end the general questions, let's say. And this is a little bit of a scene when we talk about cyclical industries, but let me ask you this question. Do you think that this time is really gonna be different? Like, when we're in a cyclical industry, we always think, okay, this time people will have restraint, capital won't flow again to bring on new supply, and it won't end up in tears. And in coal, it might happen because there's, I mean, they cannot finance themselves. There's really a lot of obstacles for new capital to come into the scene. So do you think this time is different? Like we can have a sustained, like you said, like a grandpa stock style sustained cycle in coal?
Um,
I won't quote you,
so,
on this.
so yes and no is the answer. This time isn't different because, well, I mean, we're just watching marginal ton economics play out in real time. Is all that's happening. This is like Econ 101. When you don't have enough of something, the price goes up. But what is different is that access to finance it's not zero, but it's not good either. Getting permits in developed nations for new coal mines is really difficult.
Almost impossible. Yeah.
Almost impossible. So like that's different. That's not how it was 30 years ago or 40 years ago. So, and my track record of predicting, policy or geopolitics or whatever is unblemished by success. But as long as those policies stay in place that are targeting the coal industry in developed markets to not be able to produce for what is a global commodity, we're going to have this push and pull of price for both the thermal and the met side for the foreseeable future. And so it's all predicated on demand. Where does demand go? Because supply and demand always meet. Copper is a really good example for this year. The price got up to $5.30 because the market was in deficit, and the market went, no, that's too expensive.
So let's cut back on that. What's interesting from a perspective of an analyst for coal to me is that there are 3-4 privileged basins in the world that produce this kind of coal that we're talking about, and I'm thinking about met. And those are in very bad jurisdictions if you want to bring new projects to life, right? So it's good for the ones that are already operating, but not so much if you want to bring new supply. So that's important to know also.
Exactly. I do think there will be some appetite for consolidation. I do think that's probably going to happen, and there will be some deals that get done that maybe you do see somebody come in for debt financing or something like that. But just taking the Whitehaven acquisition of Blackwater and Daunia, it's like, or Glencore's acquisition of Teck, like those big ones, those are all vendor financed. So, if the seller is the one brokering the deal and getting the deal done, and the bank is just sitting there and collecting fees, like this is not, the deal making environment is not necessarily conducive to greasing the skids, getting a lot of things through. So that's the whole part that's different. The attitude toward the industry, which has never been fantastic, is just really unchangeable in certain jurisdictions. Although I shouldn't say unchangeable, because I'm trying to change minds to some degree on it. Being probably the only liberal guy who works in the coal industry to some degree. But you just, as a policymaker, you have to realize that you can't go from step 1 to step 40. You have to go from step 1 to step 2 to step 3 and so forth. And it's good to put out bold goals because bold goals get headlines. But at the end of the day, you're judged on your project management. And if you can't manage the project from step 1 to step 40, you're not going to be in office very long, for one. And then also, whatever goal it is that you have is going to fail. And I don't want to see the energy transition fail. I think it's an important step for developed markets to take, because there's going to be a lot of innovation that comes out of it. There's going to be a lot of technology that comes to the forefront that we'll be able to use and recycle in different ways, maybe even in the mining sector. So I'd like to see the goals happen. I just want to see more realistic and pragmatic approaches from policymakers to make sure that we can get there. And then also to make sure that developing markets have access to energy that will allow them to do the same in 30, 40 years. Like that's the point,
Okay, yeah, for sure. And with that, we conclude like the broad topics part of the chat. And if it's okay by you, we can delve into some equities. Our biggest positions in our model portfolio are Warrior Met Coal is our biggest coal position. Whitehaven is the second one, and we have like a small position also in Peabody Energy. Our thoughts with that is that growth is something that that's different from other companies. We had also metallurgical last year, but that got a little bit more expensive. But lately we have been trying to change the approach and overweight Whitehaven, because the market hasn't really recognized the transformational acquisition that they did. So if you could touch or give us your opinion on those three equities, it would be great for us to have
Sure.
an expert's opinion on them.
Yeah, I mean, first of all, let me just make a blanket statement about all of them. I think all of them are going to perform relatively well, let's say, over the next 5 years. So over a long-term time horizon, which for me 5 years is long term. I think they're all going to be fine. In the short term, this is the down part of the cycle relative to where we just came from. So, the next year might be a little bumpy, and so I think it's probably most instructive to just sort of look at where price action has been, and to understand where investors are coming into the market to find value. And it's for Whitehaven, it's a pretty narrow. I'll share my screen. It's a pretty narrow range. Here.
While you share this, in terms of Whitehaven, do you think that when they report, because they don't report as often, or if they sell, of course, a stake to any steel maker, do you think those could also be catalysts that make it trade out of this range?
Yeah, I mean, I think, for instance, if they were to sell off, a quarter of the project or whatever to a Japanese steelmaker and offset some of the debt that they have, yeah, I do think that has a positive, a positive effect on things. The one thing I just point out on price, here's TradingView's. This is where most of the battle has been. I think for folks, the minimum, we've gotten down to is right around here. At 630, but below $6, I think it just value gets stupid. I think probably 7 is the new baseline. I think this sort of high volume is telling us that this is the line in the sand where people are kind of using as a trigger moment. All right, if it gets down below 7, we want to get involved. Now prices are kind of hanging out up at 775 and have been as high in this cycle as 845. I think this is the range until we see, a breakout of either, high calorific value thermal coal prices or met prices. So, we've moved out of, this run up from, April up to June as they take full control of Blackwater and Daunia. So we're going to start to see results, and now they're kind of path dependent on performance, right? If they prove they can digest these assets and run them at a pretty good cost, they'll really have successfully transformed themselves into a Peabody just by one acquisition overnight, which is pretty amazing.
August will be a really good statement in that sense when they report the happier results.
Mm-hmm. Yeah, so. I like it here. I like it here at 775. The phrase that I've been using with people is, if I'm accumulating a position, if I were starting now, I'm not really in a hurry to add it. I think you can just add on down days. Buy every couple of weeks like I buy every few weeks when I get paid, and I buy a little bit and stick it in the 401k and try to be disciplined enough to do it on days where the stock price is down. But that's kind of all I do. I'm just kind of incrementally buying and, dollar cost averaging into positions when I do that. And then I have, a litany of zero cost positions that form the core that, I've built up since COVID. So it's a little bit different for me, but I'm just trying to think of like a first timer into the sector.
Someone came and you,
Yeah, we're at a time in the year where, don't blow it all at once. Just be patient, buy a little bit at a time. And then be cognizant of these levels. For Whitehaven, I think, you want to start to get cautious around 815, unless we get a big move up in metallurgical prices. You want to start to add, I think, when you get down into the, 730 range down to 7. And then, of course, below 7, I think is, easy enough to add without question one way or the other. So
famous memes come to mind.
I'm not sure what your entry price is for your program, but if you backed up the truck down in here, you've done very well for the last little bit for sure.
Yeah, for sure. I was just saying that your memes come to mind, the ones from Vincent Mahon
Yeah,
that you share on Twitter with the price. My thoughts on Whitehaven are that maybe, like you're saying, if seasonality in August changes and we get a little uptick, and they show that they can run these assets, like you said, people start to see the cash flow that this can generate, then this can quickly re-rate, not as much as it was, but at least that. And I want to ask your opinion, because there's been a lot of speculation that after this acquisition, I think it's too early, but with the opportunity that Anglo American was also rumored to be thinking about spinning off their coal assets, etc., and that Whitehaven might use the momentum in their acquisition to jump in. There aren't many suitors that can do that, and they would be in. I see it as too early, given that they're still digesting this acquisition and the debt. But I wanted to pick your brain on that, or see your opinion.
Sure, it's possible, and I think they'd probably be as good as any a suitor for Anglo. I'm not sure exactly. Pardon me. I'm not sure exactly how that's going to play out, because now the ball's in Anglo's court, and they're either going to put the assets up for sale officially, and then we'll start to see who's going to be interested, or they're going to do some sort of spin-off or package. I'm not really sure what iteration that it's going to take out. Whitehaven, I think, would certainly be in the mix. Whether or not they'd be the ultimate winners, hard for me to say. I still sort of think it's going to be BHP or Glencore that winds up with them. If BHP winds up with them, that ostensibly gives them full control of the Moranbah coal measures, which would almost give them unilateral control over the PLV price, which is a pretty advantageous position to be in.
Yeah, yeah, I can see why they would be interested in that.
Yeah, so I think they're going to fight hard for it if it does come up. But I mean, as for Whitehaven, whether they win it or not, you mentioned the seasonality. I mean, we went from $6 to $8.50 from September to February here, along with the rest of the coal sector. So, keep that seasonality in mind. This is where the big swing's going to be, and probably after Q2 reports, which aren't going to be quite as good. But this is, I want to start probably accumulating positions from July on through September. And if we get down into this area again, just you can back up the truck, I think.
Okay, great. Yeah, that was great.
I'll pull up Warrior too while I think about it. This one is much simpler, much fewer lines, and you can see like here even recently we've had this big slug of duking it out at the $65 level. So my previous McMahon Laser Eyes post had $60 as kind of the initial area of interest. I think that's moved up here to 65 now.
Okay.
This volume and the volumes that we saw at 60 down to 55 are pretty equal. And we haven't gone below, what is this? In March, we got down to 52, which was just ridiculous.
Yeah, that was certainly strange.
Yeah, and I think this is probably the new bottom end of the range. I think the this former resistance / this support right here. This is probably I don't think we're going to see the stock below this level again, possibly. Where do I see it going? Well, their free cash flow in a normal year without Blue Creek would be something like, call it $250-300 million or something like that, with the combination number 7 and number 4, with the understanding that number 4, may, deplete existing reserves here at some point in time. But, if they're able to lease those reserves and they're able to bring on Blue Creek on budget, the total free cash flow that they generate per year is going to be somewhere on the order of, $600 to $1 billion in free cash flow per year. And, the market cap of the company is like a 3x at this point. So even at 65, 67, or wherever we are today, they're still undervalued. When they get to, a 6 to 10 multiple, like Alpha was just at, like AMR was just at, I mean, in my mind, this is a $120 stock. Over
our price target is at 100. I'm a little bit more conservative, not because I don't think it can be higher value, but because they have to execute on that. But I tend to agree with you. Like the budget on Blue Creek will be important, etc. And this one I think is especially interesting for two things. The first one is that the market, especially in coal where there's zero interest, is not that good at valuing growth, right? It happens the same in oil, for instance, with International Petroleum, etc. And also because they don't have as an aggressive shareholder return program right now. And they have the dividend, which is testimonial. Even though they give those little specials, it's testimonial at the moment. But they have the cash to build Blue Creek on the balance sheet. And when they get this shareholder return program, this is going to be explosive. Do you have any insights on what they plan to do, or have you talked to them in the sense that are they thinking about buybacks right now if the price were to stay at here, or dividends?
I don't know. I mean, they haven't really committed one way or the other on any earnings call, and then I've heard mixed outcomes, from private conversations. So with other people, not myself. So I think they've looked at AMR share price and seen what that's done. So they're pretty aware
of what can be done.
What can be done with the share price. If they do start buying back shares, I mean, if you make $800 million of free cash flow a year and you're only at, or $1 billion and you're only at, a $6 billion valuation, I mean, that's a good chunk of the company you can take out in a year.
And moves the needle.
So, and we've seen how, asymmetric to the upside that's been for Alpha. So if they choose that path when we get out to 2027, then, I mean, there's still room to go. It'll be 300. By the time it's done with its cycle. So, it'll double and then it'll double again. But as to whether or not they'll do dividends, I mean, if they do that, it's, probably less fun from a share price perspective. You don't get that immediate payback. But again, it's going to compound over time, no matter which direction it is that they take. So right now I'm kind of agnostic. I'm in it for the growth at the moment. To capitalize on, the acceleration of revenue and free cash flow growth. That's why everybody's here. That's why it's still probably it's still the most undervalued coal company in the market. So that's what we're here for now. And then if the investment thesis changes due to buybacks or due to a shareholder return program or to an acquisition or whatever, like, we have to cross that bridge when we come to it, I think.
Yeah, for sure.
Mm-hmm.
My thought with this is Warrior Met is my biggest position, but
mine too.
I think that Whitehaven can also provide a good punch. And now we were gonna move to Peabody, which tends to screen as the cheaper one, although it has its own story and problems there.
Yep, it sure does. And we've got this really nice volume chart over here. The fight has been between $22 and $26, and if I think that's where my last McMahon laserized chart was at, right? So how I've been approaching it is just $22 is the all right, load up, and when we get up to the 25, 26 range, you can lighten up. And I don't think there's been a better money printing machine in the business than buying Peabody at 22 and selling it at 25, 26, 28, and then just rinse and repeat for the last year or so.
And now that the volatility is gone, is not that interesting. But I remember in 2021 when I started buying it at 3 and change or 4 and change, and I used to also sell puts. They had like a 100% implied volatility or something like that, and they were like extremely lucrative to do that. So just like the range that you talked about.
Yeah, I mean, I've managed the position that I have mostly by selling premium for a year. I've gotten to zero cost that way. Over the course of holding it for the first year. I got to sell some at 30 when it got up there, but when it comes back down, I always just pick it back up because again, like Peabody is the one company in the sector that is liquid enough to put a big slug of capital to work for pretty much anybody in the space. So that's why it's been as volatile as it has been for the last long while. And of course, Elliott, in the process of completely exiting, has I think
downward pressure.
I think it's taken out this type of downward pressure, that we saw here last year. I think Elliott being gone has eliminated these types of outcomes. Can we get down to 21 or 20? Yeah, I think so. If prices were really bad or the market was really bad, but in general, like 22 to 26 is where we're going to be until Centurion comes on, and then I think we go to 30 plus, depending on what to do there, and then from there it is dependent on what their shareholder return program is going to be. And again, they haven't committed really one way or the other. They're more buybacks now. That's good to see. But
they've executed pretty well in that sense.
Yeah, and I know a lot of people have complained about management or communication stuff like that, but Peabody's a 150-year-old company, so you're not going to get any founders that are in there, from a family basis. And really, from an operational perspective, they've done pretty good. So I'm hesitant to sort of pile on. I wish they were better communicators, but I wish that of a lot of companies. So, and they're not necessarily unique in that regard, right?
They've also gotten better because the hedges drama and then the shortage drama, etc. That was a little bit of a drag for the price. I remember one quarterly report when they were up like 20% and they started the conference call and it ended up in the red. I thought, okay, they can do any worse, but they've gotten better with the Coronado fiasco also.
Both of those instances, I was listening to the call and I saw the share price start to tank, and I went on Twitter and pounded the table. On Twitter, by the way, I'm at MF Warder. If you want to follow me there, you can also follow the Coal Traders Newswire feed at Coal.
I will leave both handles, and I recommend everyone following.
But I mean, I went on Twitter and pounded the table. I was like, that's not what they said. They didn't say they're going to acquire anything. They said they're looking at it. It doesn't mean they're going to do it. And then likewise, when they, the communication about, I think it was sureties in the one, in the one call, again, they didn't say what the market was thinking that they said. And, when I say, which companies were better communicators, sometimes there are, jargony things that are kind of, inherent to our industry that if you say them in a certain way, don't necessarily translate over into the generalist space. And so, and with retail more involved in coal now, I think C-suites, executive staff have to be even more careful about how they communicate their ideas, because there are way more non-experts involved in the sector now than there used to be. And you can't talk to, a non-finance person or a non-coal person in the same way, that you do people who have been involved in the industry for 20, 25 years. And, Alpha is really good at that. They're pretty straightforward, tell you exactly what, they're thinking and where they see things going forward. Other companies are getting better at it, but, that's one room where everybody, I think, can improve. Just recognize that your audience has changed and communicate simpler. Pretty much it.
They say, position accordingly.
Yeah, right. Yeah, exactly. But yeah, I'm really optimistic for Centurion. I think that's going to move them into a better cash flow position. I think they are going to be able to buy back shares and do something.
And eliminates part of the terminal value risk.
Exactly. Yeah. And there will be some peccadillos in there. I think some of their mines deplete as well. So there's a mix of shift from. I think some of the thermal coal mines go away, maybe one of the lower value met, and you're kind of replacing it with Centurion, which is a higher value mine in general. So, by and large, I think they're in a much better spot than a lot of people give them credit for, and definitely below $22. I'd be buying it all the way down below 22 to wherever it goes from there. If it happened to, if we happen to have a big pullback from a macro perspective.
Yeah. Okay, great. Yeah, we will be attentive to your Vince McMahon memes. And just to wrap up, because I don't want to tie up a lot of your time. Thank you again for being here. We
Mhm.
have 3 questions from our community that I would like to ask you.
Sure.
Some of them we've touched a little bit on them, but others not as much. The first one is, um, do you follow any kind of data or indicators that would um, that would make met prices go below 200, or thermal below, and he's referring to Newcastle below 120, for instance. You say, okay, I want GDP growth or PMIs or whatever, some macro indicators that you think, okay, this could be a warning sign that things are going really bad, and that might cause a downturn. Do you follow any signal specifically?
No, not any one thing specifically. I mean, the most important macro figure for like the United States is PCE, because that's a proxy for GDP. 70% of U.S. GDP is consumer spending. So if you want to get a sense of how well the economy is doing, you can kind of look at that for to get a first derivative look at it. And other countries are sort of similar in that fashion, but really, I think China macro data matters. Uh, if their GDP goes in the toilet, well, that's going to affect the whole enchilada around the world.
Yeah.
Likewise, if India were to have a really serious downturn or a delay in the industrification of, in the build out of all these, all these steel plants, or if China collapsed but was still producing steel in an overcapacity sense. And keep in mind, Xi has basically said, don't do that here pretty recently. So they're starting in Fujian to crack down on overcapacity, and they're starting with, environmentally terrible operations and things like that. So they're going to do the same thing they did with coal, push down on the bad operations and let the good ones ramp up capacity to the max. If that has a bad outcome, that could throw cold water on the on the rest of the sector. But again, if that happens, it's going to affect everything, not just coal. So if that's the case, then you want to be defensive on literally everything, including this sector. So that I think is probably the biggest existential risk. Some kind of a global hot war. Although that could send commodity prices going in the other direction. To be fair,
let's hope it doesn't get anywhere near that.
Yeah, but I mean, that's
risks. Yeah,
that's the risk. The tail risks. Will Russia increase production, to ridiculous levels and be able to export through Iran? I think that's to be determined. But Russia's enough of a black box that they can do things behind the scenes that we won't know about while they're sanctioned and not really sharing information with the rest of the world. So that's another one. But I mean, the rest of production is in the Western world and is reported on pretty regularly. So I think we'll know in our necks of the woods, respectively, like how things are going. But it's I think it begins and ends with China. And if things are going to be bad there, like genuinely bad, then we'll revisit the met coal thesis, after that trough of the cycle and see where we're at that point.
Yeah, great, Matt. And the next question is, there's a user that has been screening a lot of other companies, ones that we don't follow or don't follow us closely, and he came across a name that I know that you too follow, which is Corsa Coal, no? And he wanted to.
Right.
I also had some comments on that. Okay. And he wanted to know your quick take. Of course, you don't have to get into it, but yeah. He says it's too cheap to ignore. What would you say to him? Yeah.
Maybe not. We'll see. So it is. The story of Corsa is, for those who don't know, it's like the micro cap of the coal industry. I think it's like market cap is like $30 million US or something like that. Super tiny, super liquid, just and kind of not a great asset. The coal quality is really good. It's a low volatile metallurgical coal situated in Pennsylvania, northern Appalachia. It exports through Baltimore, so it got affected by the by the bridge collapse here pretty recently. But most of their business is done domestically, and domestic negotiations, which usually start in August, have already begun. So the steelmakers have looked at those U.S. coking coal prices, which are sort of scraping along the bottom, and they figured now is the time to go in and take advantage.
Yeah, to screw these guys.
CORSA has always been one of the first to settle, and the first offers are not always the best. But you have to keep in mind, from their perspective, they want to make sure that they have production locked in so that they can keep their labor, so that they can keep the lights on and keep moving while they try to improve, their balance sheet, while they try to improve and bring on additional production. They may look for a financing at some point. But last year their domestic price was about $150 at the mine, and their costs this year have been about $150.
Yeah.
So it's very touch and go. If they produce and operate well, they're fine, but it's basically a single asset, and there's a lot of mining risk that comes when you own a single asset company. Yeah. So we're not at the point in time in the cycle where I'd feel super comfortable saying 2025 is going to be a banger for them. I think we have to wait and see where they settle their domestic business at, and then if it's a good result, you can chase it. But if it's a bad result, you don't want to be holding it when they announce it, because it probably won't be so great.
Yeah,
so that's kind of where I'm at right now. I don't hold a position. It did really well for me last year. Didn't quite triple in it, but came pretty close. This year's a very different story though. So it's on my wait and watch.
Yeah, be cautious. Exactly.
I mean, if they come out and do a financing, I mean, it's going to get cut in half. So just watch out.
Okay, so yeah, that's a warning sign. And I saved the best for last. This was my favorite company. I also had the chance to talk to Andy, and he said some merch that I wear proudly. I'm always representing Alpha, and it used to be a big position for us, our biggest position. We sold too early. That always happened, but at least we changed it for Warrior in the 30s, high 30s. So that was a good change, but it always hurts to look at the price and see what could have been, right? And a user asked, okay, can you ask Matt's opinion on Alpha Metallurgical now, because buybacks aren't being as effective, their margins aren't as big as, of course, when price was higher, and so the combination of a higher valuation, buybacks not being as effective, etc., can be dangerous when you're priced for perfection.
Well, the buyback isn't on at the moment, or at least it's not on to my knowledge.
Exactly. They said that, yeah.
Yeah, they've been pretty transparent about they want to have cash balance of about $300 million at least in order to be able to run the buyback program. So they're still building the cash coffers back up. And Q2 has not been great for the United States in terms of pricing. I wrote a piece on Substack a couple of weeks ago talking about how I think the Platts and Argus, the people who are assessing the U.S. market, are doing it a disservice, because they're basically saying India is the only market that matters, and it's not. Like, if India is the only market that matters, create a CFR, like delivered price, and have everybody compete into India at that price. But we wouldn't, for instance, take an Australia coal. A U.S. price delivered into Brazil, price Australian coal at that plus a premium, and then back out shipping. If you did that right now, you'd get to about $190 for PLV, FOB Port Australia. No Australian producer is going to agree to that. And similarly, U.S. producers really they're not doing any business at those spot levels anyway. So the contracted levels, a lot of them are PLV linked. So wherever the PLV price is, there's an agreed upon delta. In history, that's usually been about $5 or $10, at best for the U.S. And a lot of times it's been at parity. So I think a lot of business gets done with a hat tip to that level, and then discounts relative to volatile content, or coke strength, or sulfur, or those kinds of things to get popped in. I do think over time that the market assessors are going to probably stop that methodology, because it's not really accurate. But for now, it sort of is what it is. And the net result for AMR has been Q2 is probably going to be a pretty low margin period, but they're going to be getting close to 300 million in the in the bank account, and are going to be moving into a position in Q3 where we're going to see prices increase. So I think the back half of the year for AMR is going to be pretty good, and again, the seasonality is going to be very similar to last year. Although I might, the caveat might be we don't get to that big peak, that we did here this year, only because in addition to prices doing really well, we also small caps just went bananas. So we had a factor exposure benefit wind at our sails during that period of time that got us up to 450. All that said, I mean, I think AMR is a $450 stock. Especially once their buyback comes on, that's where we're going to wind up over the next 2 years, 3 years, or something like that, by the natural course of human events. And it's already, I mean, that was the peak, so it's already a technical point that's out there for people to use. So
okay,
that's kind of where I think of them. I think below 300 is a good spot to sort of take a look. There was a lot of push and pull around the 265 level. It's been suggested that 225 could be in the cards if the market was really bad. I don't think so. I think anything below 300 is fine. But again, you're not in a hurry. Let the market kind of do what the market does. You can buy a little bit at a time. My price target hasn't really changed at 450. 50% upside from here over a 2-3 year time horizon. It's and best management in the business, best communicators by far.
Yes, they have top execution, top notch. With the buyback, etc.
And I'm biased, of course, because I've probably learned more about the coal industry from having Alpha as a client in the past. During my time at Wood Mackenzie and stuff. So they're near and dear to my heart for sure. And it's still a pretty big part of my portfolio. Probably going to get a little bit bigger if it stays down here in this $300 range for a while. But yeah, they're not growing like Warrior is growing. And
it's another company profile totally.
Yeah, but it's if you're going to own a basket for the run up, they got to be in the basket. That's the bottom line for prices. If you want to run concentrated, that's a different story. But my basket approach for the upcycle is some combination of Warrior, AMR, Peabody, and Whitehaven, and then depending on whether I'm optimistic on thermal coal, maybe CEIX, Consol, or Yancoal, down in Australia on the thermal side, or if I wanted to add some additional met exposure, it'd be Ramaco probably next on my list, and some combination of when Glencore finally absorbs Teck, I think that probably works its way into the mix too. But that's kind of how I approach just if I wanted to get broad exposure to kind of an index of stocks, those are the ones I typically use.
Okay, so that's everything from our side. Thank you again, Matt, for sharing your valuable knowledge with us and for finding the time to chatting. Of course, you have the invitation to join our Discord and Substack if you feel like so. It would be an honor having you. And thank you again for being here.
Oh, it's my pleasure, Albert. Thanks for having me, and to your great talking to your audience. Happy to come back anytime and chat.
Sure. So that concludes our talk. See you again. Let's hope in a couple of quarters to see how everything has evolved. See you, Matt.
See you.
Okay.